Gold is currently approaching a massive liquidity zone, and this is exactly where smart money is gearing up for the next major expansion. Now, my primary focus for this explainer is a highly specific buy setup targeting the 41.98 level. But here's the catch. There is one absolute condition that has to happen first. You see, most retail traders, they're actually looking at the completely wrong level right now. So let's break down exactly where institutions are actually targeting and exactly how we're going to execute this. Looking at the 15-minute time frame, the external draw on liquidity up at 41.98 is, frankly, remarkably clear. But here is the massive problem. Most retail traders are currently buying the breakout. They're stepping right into a trap that we absolutely have to avoid. The market is sending a glaring warning signal right now, and jumping in blindly here? Well, that's exactly what the algorithms want you to do. So our daily bias is heavily bullish, and that external draw on liquidity sitting right at 41.98. However, our current execution status is explicitly set to wait. Why is that? Well, because smart money confirmation just hasn't appeared yet. If you enter a long position right now, you're essentially buying the premium of an intraday range, and that completely violates core institutional order flow principles. All right, here's the exact institutional blueprint for today. We are strongly bullish on both the daily and the H4 timeframes. The target, buy-side liquidity resting right between 41.98 and 42.10. Now, our primary entry zone actually rests deep in a discount between 41.70 and 41.75. And this is crucial. Our hard invalidation level is set at 41.58. So now that you know the exact parameters of the playing field, let's dive into the underlying logic of why smart money is targeting this specific area. But before we drill down into those lower timeframes, we really need to understand the macroeconomic narrative driving this order flow. Recent economic and geopolitical shifts are acting as a massive catalyst for smart money right now. The algorithms are literally just using these macroeconomic volatility injections to deliver price to their existing technical targets. Let's just look at the raw data neutrally for a second. US non-farm payrolls came in at a shocking 57K actual versus the 110K expected. That is a massive statistical miss that the algorithms priced in immediately. At the same time, the probability of a Fed rate hike has dropped down to 53.2%, and over in the energy markets, WTI crude oil has dropped below 68.50. This is happening as Middle East tensions ease, with diplomatic progress reported between the US and Iran, ensuring safe passage through the Strait of Hormuz. So what does this all mean? All of this translates to a repricing of the US dollar, which acts as the underlying fuel for gold's macro rally. Okay, moving over to the technicals, let's really dive into this H4 structure. Notice that major liquidity sweep right below the 39.50 level. Right after taking out those long-term sell stops, smart money stepped in incredibly aggressively. We're seeing a very clear change of character here with massive displacement, rapidly rebalancing price back into unmitigated fair value gaps. The institutional footprints are firmly in control right now, and the order flow is undeniably bullish. Now, if we look at today's event schedule, you'll notice a complete lack of Tier 1 US dollar data, but instead, we've got Eurozone PMIs and a highly anticipated speech from ECB President Lagarde. Institutions are absolutely going to use these specific European events to engineer liquidity pools. They'll leverage the volatility from these speeches to hunt stops in gold before finally expanding up to their true macro target. And this leads us to the critical scenario that, honestly, most traders are just ignoring. On one hand, retail focus is squarely on buying the current premium breakout. They see green candles, they chase them, basically treating the market like a casino. But on the flip side, the smart money target is entirely different. Institutions are actually preparing to sweep the minor lows established during the Asian session. They need liquidity to fuel that next leg up, and they're going to extract it straight from those early retail buyers. This trap is going to spring in a highly specific area. Resting perfectly between 41.68 and 41.74 is a glaring open 1-hour fair value gap. This is the magnetic draw. Smart money will very likely push price down into this exact pocket to purge those early retail buyers. They're accumulating their own long positions at a deep discount right as that London to New York session transition happens. So the crucial part here is knowing exactly when to execute. Here is our highly actionable 3-step execution model. Step 1, you wait patiently for the liquidity sweep of the Asian minor lows, right between 41.75 and 41.77. Step 2, you watch price pierce deeply into our H1 fair value gap at 41.70 to 41.75. And step 3, and I can't emphasize this enough, this is absolutely non-negotiable. You wait for an M15 market structure shift with strong displacement. That confirms the institutions have stepped back in on the buy side. Once that confirmation actually prints, here is your exact executable ICT trade plan. The setup direction is a buy. Our entry zone is strictly between 4170 and 4175. The stop loss is placed logically just below structural invalidation at 4164. Take Profit 1 targets internal liquidity at 4195, and Take Profit 2 targets the external buy-side liquidity up at 4198. This specific framework offers a phenomenal risk-to-reward ratio with an 85% execution confidence score. I really cannot stress this enough. As the old institutional adage goes, entering long here means buying the premium of an intraday dealing range. Think about it. It's the equivalent of paying top dollar right before a massive clearance sale. Buying before the liquidity sweep occurs is a fatal error. You just have to let the algorithm do its work and clear the board of retail stops first. Let's drop down to the 15-minute chart and see how this is building in real time. Right now, price is printing minor distribution candles at the exact top of the daily range. The market is sending us a massive warning signal. This is the classic setup for the Judas Swing. It's a deceptive stop hunt driven aggressively down into our fair value gap, designed solely to shake out weak hands before the true expansion higher actually begins. However, every professional institutional trader knows exactly where they're wrong. 4158 is our absolute structural invalidation level. If a 15-minute candle body closes below this number, the short-term order flow shifts to bearish. The entire intraday long framework collapses, and all buy setups must be immediately canceled. We trade on strict logic and invalidation, never on hope. To safely survive and profit from this engineered expansion, you really need institutional-grade risk management. So here are the prop firm rules required for this setup. Allocate a maximum of 1% risk per trade. When price hits our first target at 41.95, you take 50% partial profits, then immediately move your stop loss to break even to protect your capital. Finally, leave a 20% runner for the higher timeframe draw all the way up at 42.10. To quickly recap our analysis, our macro bias is bullish. Our final external target is 41.98. But we are waiting for that New York Judas swing into the 4170 discount array before executing any longs. If you value this type of precise institutional-style market analysis, make sure to subscribe to ICT Market Theory. We deliver these blueprints to keep you consistently on the right side of smart money. And if you're looking for a reliable, professional environment to execute these specific setups, you can find the FXTM account link down in the pinned comment below. Remember, the market is a highly engineered mechanism designed to transfer wealth from the impatient right to the patient. So will you be the liquidity today, or will you wait for the trap to spring before making your move?